There's a particular kind of discomfort that comes from watching something you believed in lose value in real time. Gold and silver have dropped sharply. The charts look painful. And across financial media, the message being repeated with increasing confidence is simple. The rally is over. Get out while you still can. But that narrative deserves scrutiny, because markets have a long history of looking most dangerous precisely at the moment they are most worth holding. This is not a story built on optimism or hope. It is built on data. And before that data is examined, one thing matters: credibility. When gold and silver were trading near their peaks, warnings were issued that a significant correction was coming. Those warnings proved accurate. Prices fell in line with what was projected. That track record is not mentioned to impress. It is mentioned because it matters when the same analytical framework now points in the opposite direction of what the crowd is saying. The crowd is saying sell. The data suggests otherwise. And understanding why requires looking not at today's price, but at the full picture, historical, structural, and geopolitical, that surrounds this moment. Markets have been here before, not in the abstract philosophical sense that volatility is a permanent feature of investing, but in the specific, documented sense that gold and silver have crashed during moments of peak fear and then recovered to levels that made selling at the bottom one of the most costly decisions an investor could have made. In 2008, as the global financial system fractured, gold fell by 32%. The headlines at the time were not subtle. Analysts declared the precious metals cycle finished. Retail investors, watching their portfolios deteriorate, sold. And then gold rebounded, sharply, decisively, and over the following years, to levels that dwarfed the pre-crash highs. Silver told an even more extreme version of the same story in 2020. As the world locked down and uncertainty reached levels not seen in generations, silver collapsed to $12. Those who sold at $12 watched silver subsequently move to nearly $30 within months. The pattern is not coincidental. Crashes in precious metals during periods of broader market stress have historically represented accumulation opportunities for those with the conviction to hold and the data to understand what was actually happening beneath the surface of the price. To understand where gold is going, it is necessary to first understand where the broader stock market stands. And right now, where it stands is on historically dangerous ground. The Shiller price-to-earnings ratio, a measure of stock market valuation that smooths earnings over a 10-year period to remove short-term distortions, is currently sitting at 40.58. That number requires context to fully appreciate. In 140 years of recorded market history, that level has only been exceeded twice. Once in 1929, in the months before the most catastrophic market collapse the modern world had ever witnessed, and once in 2000, at the peak of the dot-com bubble, before equities lost more than half their value over the following 2 years. This is not a minor statistical footnote. It is one of the most reliable long-term valuation signals that exists, and it is flashing at an extreme that has almost no historical precedent. What is relevant to gold and silver is what happened after both of those previous extremes. When overvalued equity markets broke down from those levels, capital did not simply disappear. It rotated. It moved into assets that held value independent of corporate earnings and central bank policy. It moved into gold. The conditions that preceded those two historical moments are present again today, and the destination for displaced capital is likely to be the same. While retail investors in the West are debating whether to sell their gold and silver positions, something far larger is happening at the sovereign level. And it is happening quietly, deliberately, and with implications that dwarf anything occurring in the retail market. Reuters reported that Chinese regulators have been advising the country's major banks to reduce their holdings of U.S. government bonds. The stated reason is concern over the long-term creditworthiness of the United States as a borrower. That is not a minor diplomatic signal. That is one of the largest creditor nations on Earth formally reconsidering its relationship with the asset that has served as the foundation of the global financial system since the end of the Second World War. The question that follows is straightforward. Where does that capital go? When sovereign-level money exits U.S. treasuries, it requires a destination. And the destination that has historically absorbed that kind of institutional geopolitical reallocation is gold. This is not speculation. China is already the largest central bank buyer of gold on the planet. That position was not built by accident or sentiment. It was built through a calculated multi-year strategy of accumulation, one that has continued regardless of where the paper price of gold has moved in any given week or month. The current crash in price does not interrupt that strategy. For buyers operating at that scale and with that time horizon, it likely accelerates it. There is a version of the gold story that gets told in terms of weeks and months, price movements, technical levels, short-term catalysts, and then there's the version that gets told in terms of decades. That version is far more difficult to ignore. Over the last 50 years, the US dollar has lost 99% of its purchasing power measured against gold. That is not a projection or a forecast. It is a documented arithmetic fact drawn from the price history of both assets across half a century of monetary policy, deficit spending, and currency expansion. Within that 50-year decline, there have been 4 distinct periods where the dollar rallied against gold, 4 moments where the narrative shifted, where confidence in the currency recovered, where voices in financial media declared that the dollar had reasserted its dominance and that gold's role as a store of value had been permanently diminished. Each of those rallies was real, and each of them was weaker than the one before it. The trend line does not lie. Every rally in the dollar against gold has represented a lower high. Every subsequent decline has pushed purchasing power further into territory from which it has never recovered. What is being called a crash in gold today sits inside a 50-year structure that has only ever moved in one direction. The short-term noise is loud. The long-term signal is louder. When gold fell during this most recent correction, it did not fall into a vacuum. It fell into a zone where a specific and identifiable category of buyer was waiting, and the subsequent price action made that buyer's presence impossible to overlook. Gold dropped and then bounced hard. From the correction low near $4,400, the metal moved back toward $4,900 with a speed and conviction that is not consistent with a broken market. Broken markets do not bounce like that. They grind lower, they retest, they fail. What happened instead was a sharp, decisive recovery that pointed to something more significant than retail bargain hunting. The $4,400 to $4,600 range absorbed selling pressure in a way that suggests sovereign money and central bank accumulation were active at those levels. These are not participants who enter the market based on sentiment or fear. They enter based on allocation mandates, long-term reserve strategy, and a fundamental view of what gold represents in a world where fiat currency credibility is under structural pressure. The projected target for gold in this cycle, based on the structural and technical framework being applied, sits in the range of $6,500 to $7,000. That projection is not built on optimism. It is built on the confluence of institutional demand, dollar debasement, and the historical behavior of gold during periods of peak equity overvaluation. For those looking to accumulate, the $4,000 to $4,500 range represents the zone where that accumulation makes the most structural sense. If the gold story is compelling, the silver story is extraordinary. And to understand why, it is necessary to look past the number that appears on a trading screen and into the mechanics of the physical market operating beneath it. The paper price of silver collapsed during this correction. By that measure alone, the story looks straightforward. Silver fell, sentiment broke, and the market moved on. But the physical market told an entirely different story during the same period. Lease rates for physical silver shot up sharply. COMEX deliveries, the process by which contracts are settled with actual tangible metal rather than cash, accelerated significantly. These are not the signatures of a market in distress. They are the signatures of a market under intense physical demand that the paper price mechanism is failing to accurately reflect. This disconnect between paper price and physical reality is not a permanent condition. It is a tension. And tensions in commodity markets resolve. Historically, they resolve in the direction of the physical market, not the paper one. When that resolution comes in silver, the move tends to be fast and substantial. The projected target for silver, should the physical market's underlying strength assert itself fully, sits in the range of $130 to $150, and potentially beyond that level depending on how the broader macro environment develops. Silver, at its correction low, measured against that projection, represents one of the more asymmetric setups present anywhere in the current market landscape. The paper price and the physical reality are telling 2 completely different stories, and eventually, only one of them can be right. Silver has never been purely an economic asset. Throughout history, it has carried strategic weight in industry and currency, and increasingly in the architecture of modern geopolitical competition. What is emerging now adds another dimension to that reality, and it is one that the mainstream financial press has been largely slow to engage with seriously. There are credible reports that the Chinese government has been examining and potentially intervening in a massive short position in the silver market. A short position of that scale, one large enough to attract sovereign-level attention, is not a retail phenomenon. It represents a structural imbalance in the market that, if addressed or unwound, carries profound implications for where the silver price moves and how quickly it gets there. The significance of state-level interest in a commodity short position cannot be understated. When a government of that size and strategic sophistication turns its attention to a market dynamic, it is not doing so out of idle curiosity. It is doing so because the outcome of that dynamic matters to something larger, whether that is industrial supply chains, monetary strategy, or the broader contest over which nations control the foundational materials of the next economic era. Silver, in this context, is no longer simply a precious metal trading on sentiment and jewelry demand. It is an asset sitting at the intersection of monetary policy, industrial necessity, and great power competition. That combination has historically produced price movements of a magnitude that purely financial analysis struggles to anticipate. There's a category of asset within the precious metal space that has spent the better part of a decade being ignored, written off, and left behind, and that category is now displaying a technical and structural setup that appears only rarely in any market across any asset class. Junior mining stocks, the smaller exploration and development companies whose fortunes are leveraged to the underlying price of gold and silver, have endured approximately 10 years of sustained underperformance. Capital left the sector. Sentiment collapsed. The companies that survived did so through discipline and attrition, not enthusiasm. For most of that period, owning junior miners was an exercise in patience that tested the conviction of even the most committed precious metals investor. What the long-term charts are now showing is a formation that technical analysts refer to as a giant U-shaped recovery pattern. This is a structure that develops over years, not weeks, and it reflects the slow, grinding process by which a beaten-down sector rebuilds its base before moving into a sustained period of outperformance. The right side of that U is now forming, and it is doing so with a specific characteristic that matters enormously: volume. A recent breakout in the junior mining sector occurred on volume that was described as massive relative to the trading history of the space. Breakouts on high volume carry a different weight than those that occur quietly. They suggest genuine institutional participation, not retail speculation. When a sector that has been dormant for a decade breaks out with that kind of conviction behind it, the historical precedent points toward years of outperformance against gold itself, the very asset that is already projected to reach $6,500 to $7,000 this cycle. Every element examined in this documentary, the historical precedents, the Shiller PE ratio, China's sovereign reallocation, the dollar's 50-year decline, gold's institutional buy zone, silver's physical market disconnect, the geopolitical dimensions of the silver short and the junior miner breakout, points in the same direction. And yet, the dominant message being delivered to retail investors at this precise moment is to sell. That contradiction is not accidental. It requires an explanation. The entities positioned to benefit most from a mass retail exit during a precious metal correction are not small. They are institutions, central banks, and sovereign wealth funds, the same category of buyer that was identified accumulating gold in the $4,400 to $4,600 range during the very crash that sent retail sentiment into freefall. These are participants who do not buy from other institutions at distressed prices. They buy from retail investors who have been frightened into selling assets that, by every structural measure available, they should be holding. This is the mechanism behind the title of this documentary. It is not a conspiracy. It is not a shadowy plot. It is simply the way large capital has always operated, patiently, quietly, and in the opposite direction of public fear. When the crowd sells, the institutions buy. When the crowd buys back in at higher prices, the cycle completes, and the wealth transfer is finished. The fundamental reasons for owning gold and silver have not changed because the price dropped. The dollar is still debasing. Equities are still at historically extreme valuations. China is still accumulating. Physical silver demand is still disconnected from the paper price. Junior miners are still breaking out. None of those realities disappeared when the price fell. What disappeared was retail conviction, and that is precisely what was targeted. The data does not guarantee an outcome. No analysis can. But it does suggest, with considerable weight behind it, that selling into this correction means handing discounted assets to the very participants who engineered the conditions that made selling feel necessary in the first place.